Welcome to the video. Today we break down the so-called $100,000 income trap, why high earners with low expenses still miss peak retirement growth, and exactly how to fix it. We will use clear steps, diagrams, and a couple of quick quizzes to lock in what you learn. Let's get started. Here is our roadmap. First, we set the scene. Next, we expose the hidden trap. Then, we run a defense checklist. After that, we unpack why pre-tax contributions matter, even without a match. We move into the order of operations, examine a concrete case study, take a couple of quizzes, and close with an action plan you can use immediately. Before we dive in, a quick but important disclaimer. This video is for educational purposes only. It is not financial, tax, or legal advice. Everyone's circumstances are different, so please consult a qualified professional to tailor these ideas to your situation. Let's set the scene. You are 29 years old, earning six figures, and your mortgage is roughly $1,000 a month. You have a strong base. You are maxing a Roth IRA. You have employer-funded pension and annuity benefits, and you are consistently contributing to a high-yield savings account and a brokerage account with ETFs or stocks. That sounds ideal. However, there is a critical optimization that many high earners miss, and it may be costing you long-term growth. Here is the hidden trap. Over-reliance on employer-funded plans, such as a pension or a fixed annuity. While these are valuable, they offer limited individual control and limited tax strategy flexibility. If you skip pre-tax contributions, you likely pay more taxes today than necessary. By investing 10 to 15% of your gross income into pre-tax retirement accounts, like a 401k, 403b, or 457, you reduce your taxable income immediately, leaving more dollars to invest and compound sooner. Since time is the most powerful growth factor, using it early creates more options later. This flowchart maps how each dollar flows from your paycheck. Pre-tax contributions to the 401k reduce taxable income before taxes are applied. Employer pensions and annuities sit on the side, offering low individual control. The Roth IRA is funded with after-tax dollars and grows tax-free. The HYSA provides liquidity for emergencies. The taxable brokerage offers flexibility but generates taxable events. The key takeaway is that routing dollars to the pre-tax account first typically improves tax efficiency. Now let's build a defense. First, maintain an emergency fund of 3 to 6 months of core expenses in your high-yield savings account. Second, address insurance gaps. If you have debt or dependents, consider an affordable term life policy and evaluate disability coverage. Third, target a total investing rate across retirement and brokerage of 15 to 20% of your gross income. Fourth, ensure high-interest debts are eliminated or aggressively managed. Fifth, automate your savings and schedule periodic increases to your contribution rates every 6 to 12 months. Here is a step-by-step approach. First, raise pre-tax contributions in your 401k, 403b, or 457 to 10 to 15% of your gross income. Second, continue maxing the Roth IRA if eligible, while staying aware of income phase-out thresholds and your filing status. Third, maintain your emergency fund at 3 to 6 months of expenses and refill it if you draw it down. Fourth, continue tracking your pension and annuity but avoid relying on them exclusively. Fifth, after meeting your pre-tax and Roth goals, direct additional savings to your taxable brokerage account. Finally, review your plan annually to adjust contributions as your income grows and to rebalance your investments. Let's compare a taxable brokerage to a pre-tax workplace plan. A brokerage account offers liquidity, flexibility, and no formal contribution caps beyond what you can save, but it generates taxable dividends and capital gains annually. In contrast, a pre-tax 401k or similar plan provides an immediate reduction of taxable income and tax-deferred growth, which can lead to a higher future balance for the same gross savings. The trade-off is reduced liquidity and rules on withdrawals and required distributions. The order in which you fund these accounts fundamentally changes your after-tax outcome. Here is a suggested order of operations. First, fully fund your emergency savings in a high-yield account. Second, prioritize a pre-tax workplace plan to immediately reduce taxable income and speed up compounding. Third, fund a Roth IRA if you are eligible to build a tax-free bucket. Fourth, if you have a high-deductible health plan, consider an HSA for its triple tax advantages. Fifth, Add taxable brokerage investments for flexibility and optional early financial independence runway. Sixth, consider extra mortgage principal payments if the interest rate is higher than what you can safely earn elsewhere. Finally, allocate funds to lifestyle and charitable goals consistent with your values. This pie chart shows an example savings mix that prioritizes pre-tax contributions, then Roth IRA, followed by HSA if applicable, with the remainder going to brokerage and periodic HYSA top-ups. Your exact mix will vary, but the key idea is to give pre-tax contributions a leading role to harvest immediate tax savings while still maintaining diversification across tax treatments. This timeline highlights milestones from age 29 to 45. You start by contributing 10 to 15% pre-tax. At 31 and onward, you increase the contribution rate by 1 to 2% with each raise. By 35, your emergency fund is fully established. By 38, you have consistently maxed the Roth IRA. At 40, your taxable brokerage surplus is robust enough to enable early financial independence options. By 45, you achieve a tax-diversified portfolio across pre-tax accounts, Roth accounts, and a brokerage account. Let's run a simple case study. Suppose your gross income is $100,000. You contribute 12% pre-tax, which sends $12,000 to your 401k. If your marginal tax rate is approximately 24%, your current year tax bill falls by about $2,880. Those dollars continue working for you instead of going to taxes. After you have secured the pre-tax benefit and maintained your emergency fund, you continue funding your taxable brokerage for flexibility. These are simplified estimates for illustration only. Actual tax outcomes depend on your full tax situation. Here is a quick Markdown cheat sheet. First, for your savings rate, aim for 15 to 20% of gross income across retirement and brokerage contributions. The formula is total invested divided by gross income equals your savings rate. Next, follow the priority stack. Maintain 3 to 6 months in your high-yield savings account, contribute 10 to 15% to your pre-tax workplace plan, add a Roth IRA if you are eligible, consider an HSA if you qualify, and then add funds to your brokerage account. Finally, nudge up your contribution rate by 1 to 2% with each raise and review allocations annually. Quiz time. If there is no employer match, which contribution typically comes first to improve tax efficiency and compounding for a high earner at 29? Option A, pre-tax 401k, 403b, or 457 contributions of 10 to 15%. Option B, only taxable brokerage contributions. Option C, only Roth IRA contributions. Option D, extra mortgage principal before any investing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, pre-tax workplace plan contributions of 10 to 15%. Reducing taxable income now typically accelerates compounding and often produces a larger after-tax outcome over time. Even without an employer match, the immediate tax deduction is valuable. Second quiz. How large should your emergency fund typically be before ramping up taxable brokerage investing? Option A, 1 to 2 months of expenses. Option B, 3 to 6 months of expenses. Option C, 12 to 24 months of expenses, no exceptions. Option D, 0. Invest every dollar immediately. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, 3 to 6 months of expenses. This cushion balances resilience with momentum so your investing plan can withstand unexpected events without forcing you to liquidate investments at a bad time. Here are the key takeaways. Do not rely solely on your employer's pension or annuity. Diversify your control and tax buckets. Prioritize 10 to 15% in pre-tax contributions to lower taxes and speed up compounding. Maintain a 3 to 6 month emergency fund and address insurance gaps. Target a 15 to 20% total savings rate across retirement and brokerage. Use a consistent order of operations to reduce decision fatigue and stick to the plan. Here is a simple 7-day action plan. Days 1 and 2. Verify your emergency fund and set a clear target. Day 3. Enable or increase your pre-tax workplace contributions to reach 10 to 15%. Day 4. Confirm your Roth IRA eligibility and set up automatic monthly funding. Day 5. Review insurance needs, including term life and disability coverage. Day 6. Establish or increase brokerage auto investments once your pre-tax and Roth are on track. Day 7. Schedule a 6-month review and plan to increase contributions by 1 to 2% with your next raise. Thanks for watching. If this helped, please like the video, share it with a friend, and subscribe for more. I would love to hear your plan or your questions in the comments. See you next time.